There's no stress.
But it's such a pleasure to be here with both of you. Thank you very much for having me.
Thank you so
very
much.
Yeah. Thank you. All right, Gautam Duggad joins us, Head of Research, Institutional Equities at Motilal Oswal. Gautam, I'm not sure if you heard a conversation with Vikas and Deepika, but in case you don't serve them well, they're bullish on India. You want to call them after this to make them your prospective client.
Sure, Nikunj. Thanks for the lead.
What are you telling your clients right now? I mean, there's a whole narrative which has started again that markets are expensive, valuations are stretched, there is too much of optimism, and it is retail which is driving flows, not earnings and macros.
Good morning, Nikunj. Actually, I have a very contrary view. It's the earnings which is driving the flow and earnings which is driving the markets. Let me explain that in a bit. You know, Nikunj, 2010 to 20, when Nifty earnings compounded at 6.5%, Nifty gave you 8.4 or 8.5% compounding. So broadly, the earnings converged with the markets in that 10-year period. Last 4 years, between FY20 to 24, now that 9 months of FY24 are behind, we can say with reasonable certainty that we know a thing or two about FY24 earnings now. FY20 to 24 earnings are compounding at 22% Nikunj on Nifty. The Nifty profit pool in FY20 was 3.5 lakh crores, so 3.5 trillion. This year we will end at 6.64 trillion, so that's a 22% compounding. Our own broader coverage universe of Motilal Oswal, 270 stocks, the profit pool was 4 lakh crores in FY20. We will end FY24 with almost 10.96 trillion, so which is 11 lakh crores, which is a compounding of 27%. What has the Nifty compounded at in the last 4 years? 22%. Right? So markets have kept pace with earnings, which is why even at 22,000, the 1 year forward price to earning ratio of Nifty is about 20 times. The 10-year average is 19.5 times. So we are well within our long period average range. Where things are a little bit expensive is clearly mid and small cap. The mid cap index is trading at a 30-40% premium to Nifty. Now obviously there are pockets in mid caps where things have run ahead of themselves, earnings need to catch up. But the flows have also played a part here, Nikunj. CY22, the domestic flows were $32 billion. CY23, it is about $22 billion. So in 2 years, CY22 plus CY23, you received $54 billion of domestic institutional flows. And January also about $3 billion. Right? In the same intervening 25-month period, FI flows were very flattish because in CY22, they sold somewhere about $17 billion and in CY23, they bought $22 billion. So that is about $5 billion of inflow. But in the first month of CY24, they again sold close to $3 billion. So it's been very flattish in terms of FI flows in the last 25 months, whereas domestic flows have been about $55 billion. Now, large part of the domestic flows, if you look at the segregation, the mid and small cap oriented schemes have received good inflows. And there also the earnings have been decent. But as it usually happens in a bull market, sometimes some sectors run ahead of themselves. And then after a period of time, they need to cool off. But I clearly believe that the bull run which we are in the midst of is led by corporate earnings. Very few markets have a confluence of good macro and micro today that India enjoys globally. Now 7% GDP, 5% inflation, current account under control, crude prices behaving, 10-year GSEC at 7.2 and currency stable. And on top of that, such a resilient corporate earnings. I don't think this combo is available in many markets or markets with a size of 4.4 trillion market cap.
I completely endorse that we are in for a Mahakumbh of Capex. We are in for a binge in terms of per capita and we are in for a huge expansion in terms of where the new sectors are getting created. So I don't want to challenge your thought here because everybody endorses it. But I'm simply curious here to understand that what could go wrong? I mean, investing is also about understanding risk. So what could be the risk, barring few global events which we don't know of? What could be the risk to the earnings? For example, I'm breaking it for our viewers. Inflation turned out to be a risk in 2022 and 23. What could be the risk now?
So Nikunj, the big risk always is in the unknown. right? Any risk which you can forecast gets discounted by markets very quickly. Be it a crude oil prices, direction of interest rates, GDP slowing down a little bit here or there, or corporate earnings missing a quarter or two. That never creates a very durable correction in the equity markets. Markets correct in a durable fashion with big magnitude only when an unknown risk hits you, right? COVID was unforecastable. Taper tantrum was also unforecastable in 2012-13. Similarly, in 2017-18, the March 2018, the NBFC crisis, the ILFS event, nobody could forecast that. So I would think that is one of the most important elements to contend with when you are navigating through such a roaring bull market. That risk can come from any place, and the biggest risk is in the unknown. Now, what are the known risks? The obvious risk is we are heading into an election season, which has a significant bearing on policy implications. Market is largely discounting political continuity after the round of state elections that we saw in December. That is why suddenly in the month of December, you saw $8 billion of inflows, Nifty giving you 8% return in a month. So by and large, most of the pre-poll surveys, including Times Now, your own group, last week they came out with a survey predicting 336 for NDA, then another survey predicted 366. So political continuity is well discounted. If for whatever reasons the election outcome is not to the market's liking, that could be a very big risk factor in the near term. That aside, the direction of interest rates, people are discounting in the next 6-9 months, interest rate cycle will turn. If for whatever reason that doesn't turn, that could also act as a big risk factor. And last risk that I want to highlight is that a lot of investors who have entered in the last 4 years, March 20 you had 35 million demat accounts. March 24 as we approach, right now we are sitting at 145 billion demat accounts. So whoever has entered in this market in the last 4 years has not seen any correction or any durable, a prolonged period of zero or no returns. Therefore, there is a little bit of complacency in that segment of the market, which sometimes acts as a very big risk, and market has its own ways to inject an element of reality every now and then.
The HDFC Bank and SBI as an indicator of economy, Gautam, because they are, between them the market share I think is more than 35-40%. HDFC Bank is talking about growth slowing down. SBI is talking about growth anywhere between 13 to 15%. So aren't these early telltale signs that the base effect has kicked in?
Nikunj, on the contrary, I believe if we manage to keep growth at 15% at the system level for credit growth, it's a very strong number. Because do remember, we are not going to grow at 20% credit growth like we saw in 2003 to 10. The size of the economy, the size of the credit, overall credit in the economy was very different then. So you compounded at 20% credit growth in that era. Second, you today have a very important legislation in place, which is Insolvency and Bankruptcy Code. So today you don't have a situation where every promoter, every company walking into a branch of a bank and taking a loan for capex. Today's capex is very different than the capex cycle you saw in 2003 to 10 period. It's very niche. It's focused on very selective segments, and that's a good thing in my view, because even if the growth at the credit, systemic credit level is a few percentage point lower, but it is very calibrated and very prudent, and it doesn't induce any big asset quality shock that we've seen in the early part of this millennium. My point is, if we manage to grow at 14-15% credit in the economy for next 2-3 years, the good quality banks can easily compound their earnings in 17 to 20%. But to your specific point on HDFC Bank and SBI, for last 2 years, we've been having a significant overweight on PSU banks. The two big stocks in our model portfolio have been SBI and Bank of Baroda. And this is the first quarter of the results season, first quarter where in banking, we have seen PSU banks outperforming private banks on earnings. First quarter where I have seen private banks earnings getting cut and PSU banks earnings getting upgraded. And all said and done, despite the recent run-up, the PSU banks are still trading at 0.9 to 1.2 price to book. I think there is a lot more steam left in the PSU bank cycle. And at the private bank level, I think while valuations have derated a lot, given the ownership in some of those names, there is a possibility that while earnings growth and fundamentals look very strong, the market cap compounding may lag a little bit more.
You've seen big upgrades, and if I look at your note as well, in autos. That's a meaningful sector. It's a very large contributor. How should one look into this sudden uptick in demand in autos? Do you think it will sustain? Do you think one should build up on this auto theme, whether it is export to domestic or EV now?
So Nikunj, let me give you one context on auto. Between FY18 to FY23, the auto earnings are absolutely flat in Nifty at about 30,000 crores. The FY18 was the earlier peak when auto earnings in Nifty, were 30,000 crores. In an FY23 also, it was about 28,000 crores. FY24 is the first year of a big auto earnings growth, right? We have seen auto earnings doubling in FY24, which is why a year and a half back we had gone overweight on auto from underweight. Having said that, now we are entering FY25 where you have to contend with a very high base, and management commentaries on auto has been very mixed. Nothing taking away from the great delivery for last 5 quarters in a row. In fact, I would go one step ahead and say auto has been the best performing sector on earnings in our coverage universe 5th quarter in a row. In fact, for this quarter also, we have seen a 60% earnings growth while our expectation was 34%. And as you rightly mentioned, it is a sector which has seen the highest quantum of earnings upgrade at about 7% within Nifty. So much so that all the 6 Nifty auto companies have posted numbers which are either in line or ahead of expectations. That being said, I must also point out that FY25 can be the year of normalization for auto. While it will remain healthy, but the quantum of growth that you might see will not be similar to what you have seen in FY24 because the outlook on various segments as far as volume is concerned is very modest. Anywhere between 4 to 8% volume growth. CV, lot of managements have highlighted that the growth is moderating there. The best performing segment will be two-wheeler insofar as volumes are concerned. And then you are also contending with a high base of margin in FY25. So our expectation for FY25 earnings growth is about 10 to 15%, and which is why in the January revision of our model portfolio, we have again reduced auto from overweight to now neutral.
I wanted to understand your outlook when it comes to the IT sector as well, because in Q3 we clearly did see that weakness in a lot of the key verticals as well. Going in, do you believe that the softness is going to persist when it comes to key verticals and geographies?
Yeah, I mean, if you go by the management commentaries of last 9 months, you have seen a situation where for 2 or 3 quarters in a row, we have seen guidances getting revised downwards by some of the large companies. Second, the expectations are very muted. In fact, if I were to talk about the current quarter, we were expecting flat earnings, and flat earnings is what we got. So they met our muted expectations, but the commentary on demand, the discretionary spending, decision-making cycles, net hiring. I mean, this quarter we have seen net hiring number at a negative 16,000, which was negative 18,000 in second quarter. So that is giving you some semblance of idea as to what the future holds, at least in the short term. But the business can remain slightly more challenged in the short term, but stock prices are now factoring that in, which is why if you look at the last 6 to 9 months, the IT sector has not corrected much. In fact, we've written multiple notes on banks versus IT as a comparison on strategy last year. And we have seen that for 12 years in a row now, the banks and IT, the relative alpha between these two sectors, the divergence is huge. On an average, there is a 35 to 37% alpha. So basically, if you have to take one call right at the beginning of the year, it better be between banks and IT. In fact, FY23, if you see, despite all the narrative about IT slowing down, etc., IT index gave you 24% return. Bank index gave you 12% return, and Nifty was up 20%. So IT has not only outperformed banks, it's outperformed the Nifty as well. I do expect the mid-cap IT to now sort of catch up with the earnings because the valuation premium over the large-cap IT has gone up significantly, and there is a possibility that you might see continued strong performance of mid-cap IT, but the stock prices may lag a little bit now to allow the earnings to sort of, to allow the valuations to sort of catch up. Whereas large cap, we find risk reward more attractive. So while we have an overall underweight stance on IT, within that, all our allocation is currently drifted towards large caps, with SL Tech being our top idea.
Okay, Gautam, thanks very much for breaking it down for us and giving us a 360-degree view of the overall earnings as well as outlook on the markets as a whole. Time to move on then, and let's put the spotlight on